This is Bloomberg Wall Street Week.
The global push into infrastructure, breaking the IPO logjam in tech.
The financial stories that shape our world.
Cutting inflation without losing jobs. Do we need rate cuts? And if so, how many? Investing in a time of geopolitical turmoil.
Through the eyes of the most influential voices.
Ken Rogoff, economist of Harvard. Former FDIC head Sheila Bair. GE CEO Larry Culp. San Francisco Fed President Mary Daly.
Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
Two presidents debate, the yen struggles, and voters head to the polls in France. This is Bloomberg Wall Street Week. I'm David Westin. This week, Roger Altman of Evercore on what's at stake in the U.S. elections.
That voters are queasy or sour about the economy.
Mary Lovely of the Peterson Institute on the Chinese economy on the eve of the third plenum.
He needs to find a way to restore confidence while also helping to transition.
And Raymond McGuire of Lazard on the wave of investment needs coming our way.
One would be generative AI. In the drop-down box there is the amount of capital that we're going to need to deploy in order to support generative AI.
We begin with the markets, where the S&P 500 reached for yet another record high on Friday, but fell down to give up 0.8% for the week overall. Still, it ended the quarter at 5460, and that is just above the Bloomberg L's year-end median number of 5450. The Nasdaq was up 0.24% on the week, while the yield on the 10-year gained 13 basis points, almost all of it on Friday, to end the week at 4.38%. For the perspective of someone putting real money to work for almost 24 years, as CIO of the California State Teachers Retirement System. Welcome back now, a longtime friend of Wall Street Week. He is Mr. Chris Ailman. So Chris, great to have you back with us. Thank you for being with us. So let's start with those elves, because you've been a fan of the elves for a good long time. You worked on getting us to reintroduce them here, figure out how to do it. Right now, if you listen to the Bloomberg elves, they say basically, you can put your pencil down and go home for the rest of the year. We're just going to be flat for the rest of the year. Does that make sense?
You know, David, I think it does. This is a good example of summer doldrums, sell in May and go away. I really think people should pay attention to these elves. I mean, it is a bit different than back with Louis Rukeyser, but they were very predictive and powerful. And the fact that they're saying that this is where the market may be at the end of the year. Look at the French election. Look how non-U.S. and particularly Europe has sold off in anticipation of that election. I think we're going to see a lot of volatility in the fall and concern about how this election goes. Last night I had nightmares. That was not a good feeling after that. So I just think the market is really capped out in here, and probably it may hit another high right away, but it's going to be trading sideways for a while.
So go below the top line number to what's going on below, because it's a pretty concentrated market. It's really just NVIDIA and a couple other related stocks driving it. Is that going to continue? Is there going to be any broadening in this market at all?
Everybody would like to see it, but the Russell 2000 is not confirming, and I don't think you will. It is an AI market. That is the whole focus. That is the growth potential. And at the start, we're just going to see, as we're already seeing now with some of the early products, some value, but not a lot of revenue. And so I don't think the rest of the market, the economy is okay. Despite what you heard last night, the economy is okay, but it's not gangbusters. So I think that the broad market stocks are going to have decent returns, but the earnings are not going to add a bunch of boost in the summertime, and we will probably, as we keep waiting for the Fed to take action, the market is moving okay with the Fed at 4.5 on that 30-year bond, and obviously they only control the short end at 5. I look at a full fiscal year, so June 30 today, we closed the books into my career here, and I have to tell you that the market was up 25% year over year at June 30, non-U.S. up over almost 15. Tremendous returns. I just don't see the gas to take it farther.
Of course, at CalSTRS, you put a lot of money to work for a long time. I mean, and you really have a long-term time horizon, given what you're doing with pensions there. Is the market indicating something longer term about AI and what it could mean for fundamental growth?
Yeah, absolutely. I mean, you look at NVIDIA, that stock alone is up 200% one-year return right now. That expectation of opportunistic growth and the expectation of efficiency in the markets and in the economy Wall Street is always overshooting and over-optimistic, and you already saw some sell back 2 weeks ago in NVIDIA because almost every mutual fund I look at, even some of the value funds, hold NVIDIA in their holdings. You couldn't afford not to, but that's going to run out of gas because it's the old question of fear of missing out. I think it's finally reaching the point. It's got tremendous growth rate, 25% in sales, but the recognition is it can't go to the moon. And where are the other stocks? So I think the market, the narrow leadership is always a concern, but we're not going to see that broad build out for a while. I think June 30 is a classic time for 401k investors to grab that statement and then diversify. They're going to find their overweight stocks, and they're probably overweight tech stocks. This is a good time to rebalance and to move some money a little bit into bonds and a little bit into other types of mutual funds.
Chris, thanks so much for being with us today, for all you've contributed to Wall Street Week through the years, and for spending part of your very last day on the job at CalSTRS here with us. We look forward to seeing Chris again in his new life. Longtime friend of Wall Street Week, he is Mr. Chris Ailman. This week, Bloomberg Invest convened in Lower Manhattan to talk with some of the leaders of global Wall Street about what investors should be thinking about. We talked with Raymond McGuire, president of Lazard, and started with what he sees as driving the need for investment over the next few years.
That goes to kind of the macro opportunities that we have, and I would put them in 5 categories. One would be generative AI. In the drop-down box there is the amount of capital that we're going to need to deploy in order to support generative AI. Data centers, as an example. Renewable energy or energy transition would be another of a macro trend. In the drop-down box of renewable energy and energy transition is how do we invest in the infrastructure that's going to allow us to remain competitive in energy transition and also be effective in how we go about energy transition. The other is, this has taken on a different nomenclature dependent upon who's communicating. It's either onshoring, friendshoring, deglobalization, or what I would call reglobalization. And the reglobalization means how do we invest in U.S. manufacturing? Remember, we peaked in U.S. manufacturing in June of 1979, where 1 in 5 Americans worked in a factory in the manufacturing base. Today, that's probably 1 in 20. And much of the dependence that we have in the manufacturing world for all the things that we do are dependent upon supply chain. So reglobalization is going to be another factor. The other factor that I would look to is the largest growing population that exists in North America is 65 years and older. And so how we drop down box, how do we engage in healthcare for that demographic? How do we manage the transfer of wealth or not? And the last is cybersecurity, macro themes. And the investment that we will have to make from the private sector is investment that we also today see being led by what's taking place in Washington. The IRA, as an example, the CHIPS Act, fundamental to how we compete going forward.
Just where I wanted to go, which is the role of private versus public. As we go forward, as you look at it from your point of view at Lazard, what is the right role for the government? What's the right role for the private sector in supplying the capital that's needed?
It's going to have to be a partnership, especially for the elements of the macro trends. In order for us to compete, it's going to have to be public-private partnerships, which we're seeing in many ways, I think, with the IRA and with the CHIPS Act. And look at the number of private enterprises that are involved in that with the support of the government. So there's those partnerships, and each one of these macro themes is going to have to be public-private partnerships. As we reglobalize, how do we invest in the elements of that reglobalization? The way that we do that is through, we need government policy that's going to be supportive, and then we need private enterprise to partner. And across the spectrum, you're going to see public-private partnerships that lead our ability to remain competitive.
Let me pick up on one of the things you've mentioned a couple times, which is workers. The number of workers, but also trained workers, particularly trained workers. In order to grow as an economy, you need more laborers. In the recent past, it appears that we've been sustained to some extent by legal immigration, actually, legal migrants being added to the workforce. What's the role of immigration in terms of the growth of the U.S. economy, particularly as you look at some of those huge projects where you need the workers and also the trained workers?
Well, apart from the political implications of that, First of all, we need to make certain that the workforce that we currently have is a workforce that is trained to be able to address the huge opportunities, the demand for labor. And my sense is that as you think about the IRA and you think about projects like Gateway and you think about the organizations today that train the labor, that there's a tremendous opportunity for us to continue to invest in that. Unions, as an example, how do we invest in that and how do we make sure that the unions are supportive so they can go train the workforce? Reducing the requirements that you have a college degree in order to do some of the work that's going to be necessary. So workforce training is critical. By the same token, workforce housing is going to be critical. So for 72,000 people commuting into this geography, where do you house them? That's going to be part of the overall thought process and part of the overall architecture as we think about projects like Gateway. And as I think about what Gateway's, the implications of Gateway, profound and exciting and a reflection of what we can do when we decide to invest in this country and invest in the most important part of the country, which is the talent.
When we talk about things like generative AI as well as energy transition, it's hard to have that discussion without talking about China somehow, because China has really put a lot of investment into those. There's obviously national security issues with China. At the same time, how can we get along, if I can put it that way, with China in terms of economies, so that we both get the best of it without conceding or compromising our national security?
So I would say when it comes to generative AI that we are ahead in the actual generative AI, the technology of generative AI. And if you look at who are the architects of that, they reside in this country. So I take confidence in that when it comes to the energy sources that are necessary for energy transition. As an example, 70 to 90% of the raw materials necessary for renewable energy transition is refined by China. And so as we think about that, we'll have to reduce our exposure to the supply chain.
That was Ray McGuire of Lazard. Coming up, the Chinese Communist Party begins its third party plenum next month in Beijing. We go over the state of the Chinese economy and what will be on the agenda with Mary Lovely, Senior Fellow of the Peterson Institute.
He has put his money down on innovation and so-called high-quality development.
That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. Next month, the Chinese Communist Party will hold its delayed plenum on economic issues. For a preview of what we should look for, we welcome now Mary Lovely, Peterson Institute for International Economics Senior Fellow. So Mary, welcome back. Great to have you here. Now, as I understand, typically this third plenum does focus on some economic issues. Going back in history, there were some major announcements coming out. This one's been delayed a year. Do we know why it was delayed?
Well, I think it was delayed because the President Xi, was focused on other events. And there may be more in the background that we don't know. One of the interesting things about the third plenum is that it allows for a bit of horse trading. Economic reforms, as China needs to undertake, create some winners and losers. And so the plenum allows a chance for multiple issues to be put on the table at the same time, so that maybe I lose in some ways, I win in others. So it allows some political bargaining to happen that may allow us to see some real progress.
Mary, let me put you in President Xi's chair right now. As he looks at his economy, what do you think his top priorities are? We have the property issues you described, local government, you've got youth unemployment, which is an issue, you've got deflation in a lot of places. What do you think are the big priorities for him?
Well, we've written recently about what we think of as China's stuck transition. So China is transitioning from its old growth model to a new growth model that we're really is just being born. And President Xi himself has warned about breaking the old before building the new. So I think that's really his problem right now. We see weak domestic demand, low consumer sentiment, low business sentiment, some signs of exit of foreign investors. So he has some work to do on the short run to revive the economy in the short run. A little bit longer term, there's lots and lots of challenges. He has put his money down on innovation and so-called high-quality development. This encompasses reforms to very broad sectors of the economy, but nevertheless, these things are things that need to be done, and the changes need to be made now. So he needs to find a way to restore confidence while also helping to transition to an economy that's really built on investment, greening the system, building a more sustainable system, and building a more equal system.
Mary, tell us about the relationship between the Chinese economy and the economies of the rest of the world. In particular, let's start with the United States in particular. There's a lot of talk about a so-called second China shock, a lot of concern about subsidies of businesses over there with exports to the United States. I could start with EVs, electric vehicles. By the way, Europe's concerned about that as well. How big an issue is that for China?
Well, for China, it's a very big issue, and we've seen this in their, diplomatic response to the U.S. claims of overcapacity. They have consistently said that the world needs their green energy products. They've doubled down on their strategy. It's not unusual in China for there to be lots of sort of rampant growth, particularly because a lot of industrial policy is uncoordinated. It's done through the provinces. And then there's a period of rationalization, and we're seeing some of that right now as some firms are surely going to exit because of weak earnings or even losses that overwhelm their ability to stay in business. So we're seeing China rationalize at the same time that we're seeing the West say, hey, no way are we going to experience what we experienced before. We're going to take preventative steps. And we saw President Biden just a few weeks ago levy tariffs on EVs, solar, medical equipment, and other products as a way to get ahead of this so-called new wave of Chinese exports.
Let's talk about those preventative measures, as you call them. I wonder, as far as you can discern, what is U.S. policy economically, specifically with respect to China right now? There was a time we talked about decoupling. You said decoupling was way too much because it's too large an economy. Then it was de-risking, but it seems like we're de-risking an awful lot of what China's trying to give us.
Yeah, I mean, every step we take seems to be more toward decoupling really than de-risking. And the reason I say that is because de-risking would have a specific targets. When President Biden puts tariffs on medical supplies coming out of China, in some sense, that's a bit de-risking because we saw during the pandemic that we were over-reliant on China for personal protective equipment and other medical supplies. So that would be a form of de-risking. But we see so many different approaches to moving away from China.
Mary, we have an election going on here in the United States, as you know, coming up in November. And of course, President Trump, when he was president, really took a very strong stance on China. It's not at all clear that President Biden backed off that for all the reasons you just described. In some ways, he even went further with it. How much of a difference do you think it makes in U.S.-China relations? Which man is the next president of the United States?
I think it makes a profound difference. President Biden has been more effective, I think, in terms of hitting China in ways that matter for U.S. security, in particular the export controls. And the key to the success of the export controls has been coordination with other nations, in particular Japan and Europe, who hold key parts of the semiconductor supply chain. Without that coordination, the export controls would not be effective. President Trump is promising 10% tariffs across the board on all nations, a so-called flat 60 on China. This is a clear signal to the other nations that the U.S. is in it for itself, so-called America First. And I think it would really undermine a lot of the policies that we're taking to push back on Chinese policies that we think are unfair, but also to diversify the global economy. So I think it is a vitally important election for U.S.-China relations.
Mary, it's always such a treat to have you. Thank you so much for your time. That is Mary Lovely of the Peterson Institute. American voters will choose between two very different approaches to business and the economy at the polls this November. For his views on the possible consequences, we welcome back now Roger Altman. He's founder and senior chairman of Evercore. So Roger, always great to have you with us. We're looking forward to this election, which everybody is doing at this point. We do increasingly hear very different points of view between, on the one hand, Bidenomics, which I think did take a departure from some of the neoliberalism, sort of less regulation, less government involvement, on the one hand, and then President Trump now is talking about things that sounds like mercantilism. He wants it all to be tariffs. Give us your sense, as somebody, a veteran of both Wall Street and Washington, what's at stake here?
Well, there are, as you say, two very different visions, and voters will have the chance to render a verdict, so to speak, on President Biden's record because it's right now, whereas President Trump's was a few years ago. There are two main takeaways from the question of Biden's record. On the one hand, I think most presidents, including the two I served, David, would be very proud to have the basics of his record. 16 million new jobs created, an unemployment rate below 4% for one of the longest stretches in American history, huge increases in private investment, and consistent growth. Even at this very moment, 4 years after this recovery began, which would have been in the second half of 2020, as COVID lessened it a bit, we're growing at about 2.75% right this minute. And to be doing that this late in a recovery is remarkable. On the other hand, we can see that voters are queasy or sour about the economy, and at the moment, rating Trump more highly than President Biden on the economy. And why is that? And I think the answer is this much discussed topic of affordability. It is true that grocery prices, gasoline prices, shelter costs have all risen in the low 20% range since President Biden took office. And I'm talking about absolute levels of increase. In other words, grocery prices in general are about 21% higher today than they were when President Biden took office. And voters are unhappy about that. Fortunately for President Biden, we're seeing some better news on that. Grocery prices actually fell last month. The inflation rate is coming down handsomely or nicely. Core PCE, which is the Fed's favorite measure, is already below 2% based on the latest data. And the Biden team is working overtime on a series of initiatives to do better. Medicare prescription drugs, insulin costs, junk fees, and a list of things which they are working hard on to lower costs for everyday Americans. And they fully admit that prices are still too high for middle-class families. So it's a bit of a split screen question. And we have 4.5 months to go, roughly, before Election Day. And that seems to me the core question is, by the time Election Day really comes, will voters have a better view of the Biden economy than they do right now? The very latest polls suggest improvement in this one category, but still a ways to go for President Biden on this question. And with voters saying that the economy is their number one issue, it's really important, if he's going to get reelected, that he close the gap further.
You know the people who run American business. How do they feel about the Biden record?
Well, a few comments on that. I served twice in the Treasury at length, and part of my responsibilities involved interacting a lot with business. And the business community always wants certain change. That's the nature of that interaction. I think you put your finger pretty well on it. The macro, from the business community's point of view, is very good. At this very moment, all the major stock indices are around all-time highs. The last few weeks have been a pretty major rally in fixed income markets. The yield on the 10-year Treasury is about 40 basis points lower than it was 3 or 4 weeks ago. That's pretty big change. And we're still seeing consistent growth, as I mentioned. So the macro, from a business community's point of view, is good. Yes, there are a lot of people in the business community that think the Biden administration is doing too much from a regulation point of view. They don't like the stance of the FTC and the Justice Department, for example, on antitrust. And some, of course, in the energy industries don't like some of the regulation that the Biden administration has promulgated in that area. However, sitting CEOs, David, of major companies do not, as a rule, endorse presidential candidates. That's not new. And by the way, today, most boards of directors of major public companies wouldn't permit their CEO to make an endorsement of a presidential candidate. So they're not going to take a position publicly one way or the other. But when they look at the Trump agenda, I think a number of them don't like it.
Okay, I'm delighted to say Roger Altman will be staying with us as we focus in on where the economy is today and particularly what is driving the markets. That's coming up next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. Roger Altman of Evercore has remained with us. And Roger, thank you for staying with us. I want to talk about the economy. We talked about it earlier a bit. But specifically, what's the relationship between what the economy is doing right now and the markets are doing? Because as you said, the markets really are, I'll use my expression, shooting the lights out right at the moment.
I think it's a pretty clear relationship, David. We're in a Goldilocks moment in terms of the economy. And in particular, we're seeing some modest slowing. Retail sales were actually down last month. There's some modest loosening in labor markets. Unemployment rate went up a touch. Ratio of job vacancies to unemployed workers went down a bit. And that slowing is enabling or facilitating a lower inflation rate. As I mentioned earlier, core PCE is already below 2%. CPI, core CPI, just above 3%. And inflation is headed toward the Fed's long-term 2% target, which in turn will allow the Fed to cut, at the moment it looks like once or twice, during the remainder of 2024 with the final amount of cuts depending on the interim inflation data. And at the same time, we're continuing, and I think it's remarkable, to show steady economic growth. At this moment, it looks to us at Evercore as though the U.S. economy is growing about 2.7%. I don't see any sharp slowing of that, emphasize sharp, in the offing. And parenthetically, corporate profits are doing well. The markets look at that and say, this is exactly what we wanted. We wanted inflation to come down, which allows the Fed to cut the federal funds rate and turn toward monetary ease. That's now happening. Looks like a soft landing, which is so much desired and so much discussed. Looks like it's playing out right in front of us. So it couldn't be better from a financial market point of view. And open market interest rates, apart from what the Fed controls, have fallen quite a bit. The yield on the 10-year Treasury I mentioned in the earlier segment is down about 40 basis points in the last 2 weeks, and that's a big move. So from a market point of view, it couldn't be better in terms of macroeconomics, which I think is why all the major indices are right around records. There's a whole separate question within the market, I mean, in terms of a subsegment of the market, about the belief that artificial intelligence may be the third, in a certain sense, the third economic revolution, and that it's going to be completely transformative. But that's not driving all stocks. That's just driving a component of them.
I want to talk about AI, but before we do that, let me ask you about that growth rate, which is above historical trend lines. It's above what economists tell us is the potential of the economy. So ironically, the economy is generating more than what economists say is the potential. Can you have, heaven forbid, too much of a good thing? I mean, sooner or later, that has to come in line, does it not?
Medium and longer term, yes. But I think there are two factors that explain why the economy, or at least above other factors, is doing so well. One is there's been a surge, remarkable surge, in private fixed investment during the Biden presidency, especially the last year and a half. It's way up. And I think from memory, and this number might be wrong, but I think it's 800 billion above the trend that would have been normal prior to the last 2 years. In other words, what the trend would have been as compared to what it actually is today. A lot of that, by the way, is foreign investment, not just domestic, but coming into this country. And some of that's been triggered by the very major legislation that the Biden administration got passed, especially the CHIPS and Science Act and the Inflation Reduction Act, and especially the green energy portions of the Inflation Reduction Act. But anyway, big surge in private fixed investment, which of course gives rise to a lot of jobs and growth. And the second factor is immigration. Most of the rest of the world doesn't have much immigration. But the United States, and people, of course, are very hotly debate whether they like the way it's playing out. But the United States, historically, and continuing right through this moment, is benefiting from consistent levels of immigration, which means that our labor force continues to grow, unlike, for example, Western Europe, unlike Japan, and before very long, unlike China. And it's very hard to grow your overall economy if your labor force is falling. So the United States has an extra advantage there, partly because our population is a bit younger than those other regions, but also because we have consistent immigration above levels that other countries have. And I think those two factors explain why we continue to grow, for the moment, above trend.
Roger, let me come back to artificial intelligence, generative AI, as we call it here. You actually are working with corporations. You're seeing what's going on. Right now, it seems like every CEO has to invoke AI in their earnings call, no matter what. And as soon as they do, their price goes up of their stock. How much of this is a proper reaction to the markets, and how much it could be an overreaction to the markets? I mean, how real is this in your assessment?
Well, two-part answer. I'm not smart enough to know whether valuing NVIDIA at $3.4 trillion, which is the current value, is sensible or it isn't. I've done this, or I've worked around in finance for a long time, and valuations constantly change, and I've learned essentially that there's no such thing as the correct valuation, because there's so much psychology that is involved in valuations. So I don't know whether the market is overreacting to this or not. But as to whether, from an industrial point of view, AI and generative AI is profound or not, the answer I think clearly is yes, it is profound. Yes, it is transformative. And some of the presentations I've listened to recently, both from companies and more generally at conferences and the like, are stunning in terms of the anticipated transformative effect of this, including in the next few years. I think what a lot of people may not have internalized yet is how fast it's happening. So valuations, it beats me, but in terms of the real economy and growth and industrial transformation, yes, it's real.
Roger, it's always so helpful to talk to you. Thank you so much for your time. That's Roger Altman of Evercore. All things come to those who wait. You may remember the slogan from Heinz ketchup commercials or a Guinness Stout campaign, but it goes back at least as far as the 19th century and an English poem by Lady Mary Montgomery Curry. This week it proved to still be true, as some good things came to some people who'd been waiting for a long time, like the Florida Panthers, who won their first Stanley Cup since joining the NHL 30 years ago. And to Julian Assange, who spent over 5 years in a British prison after being holed up in the Ecuadorian embassy in London for 7 years, all to avoid U.S. prosecution for his role in publishing some 750,000 classified documents. This week, Mr. Assange pled guilty to a single count of conspiracy, was sentenced to time served, and finally returned to his native Australia.
Julian should never have spent a single day in prison. But today we celebrate because today Julian is free. This is a huge win for Australia and for Australian democracy. This is a huge win for free speech.
To be sure, there are some who continue to wait for things to come their way, like the crypto community waiting for SEC approval of a second spot ETF, this one for Ether. Though SEC Chair Gensler says they have the key to their own jail and can end it whenever they want.
It's really about the asset managers making the full disclosure so that those registration statements can go effective and those lawyers know what that is. It's smoothly functioning. It's really up to the asset managers to make the proper disclosures.
Currency traders keep waiting for Japan to raise its interest rates and give some life to the yen after 25 years of zero or negative interest rates. But in the meantime, saw the yen fall to its lowest level against the dollar in nearly 40 years.
It's now just a question of managing the downward descent of the yen rather than changing policy. They're not going to be able with intervention alone to stem this.
For the big U.S. banks, it looks right now like waiting is the best way for things to come their way, as federal bank regulators got so much criticism of their proposal to increase reserve requirements that they've gone back to the drawing board to start from scratch.
If I were a betting person, I'd take the latter, a re-proposal, because I think the changes will be so significant, but it's probably not much more than a coin flip.
The banks and all the rest of us continue to wait for the Federal Reserve to back off those high rates it took up by 500 basis points in record time.
What matters is that first rate cut is indeed a light switch, because what that signals is the Fed believes that it has won the war on inflation, and so it's all downhill from there in terms of rates.
But this week we were told once again that we'd have to be patient.
With significant progress on inflation and the labor market cooling gradually, at some point it will be appropriate to reduce the level of policy restriction to maintain a healthy balance in the economy. The timing of any such adjustment will depend on how economic data evolve and what they imply for the economic outlook and balance of risks.
Then there's what may be the biggest wait of them all, at least for New York City, where we've been waiting for over 100 years for the promised extension of the 2nd Avenue subway line. After tearing down the elevated rail lines in the 40s and 50s in anticipation of imminent subway service, construction finally got underway in 1972, and then was suspended for over 30 years for lack of money. In 2017, Phase 1 of the 2nd Avenue subway finally opened.
First conceived of in the 20s, now 85 years later, construction is blasting forward. So far, officials have yet to raise the money or even budget the remaining phases that will extend and complete the line.
Over a century of waiting was supposed to be drawing to a close this year, as revenues from congestion pricing were going to fund finally finishing the 2nd Avenue subway. But then, as it had so many times before, the funding disappeared, at least for now.
It's $15 billion directly to the MTA, and that will spur at least another $5 billion in terms of federal funds. That's a $20 billion infusion to the transit system. It also would have resulted in more than $15 billion in bonds that were going to be issued. So it's a real blow financially to the region.
We can only hope that Lady Curry was right, that it will come if we wait long enough. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.